So when he looks at his real estate portfolio now, he has about 5 or 6 houses. And the only reason why he's not selling any houses is because he doesn't want to pay taxes. How does selling your house affect taxes? Taxes are a big part of real estate. That's because real estate has to do with money. When you purchase your house, you're able to write things off like the interest on your mortgage as a deduction, or even the interest on your homeowner's insurance. But how does selling your house affect your taxes? The answer to this question is going to be different depending on the circumstances of the sale and the tax. Let's take a look at the largest tax that the sale will affect. Long-term capital gains tax. The amount of capital gains tax you pay is determined by whether or not your home is a primary residence. A primary residence is a home that you've lived in for at least 2 out of the past 5 years. If you fit that category, you will be exempt from capital gains tax, up to $250,000 for singles and $500,000 for married couples. If you make more than that on the sale of a house, then you will then pay long-term capital gains tax. If for some reason you have not lived in the home for at least 2 of the past 5 years, you must pay short-term capital gains tax, which is taxed as income tax. For example, let's say you purchased a house for $400,000 and you thought that your family was done growing. Then, unexpectedly, your wife is pregnant and she's having twins. So now you decide to upgrade to a bigger house to fit your family, so you sell your current house, the one that you paid $400,000 for, and you sell that house for $440,000. Because you sold it for $40,000 more than what you paid for it, that $40,000 is now taxed as income as if you made that money from your full-time job. So what about investment properties? If you're selling an investment property that you never lived in, then you will pay capital gains tax on the sale of a home. But if you lived in the house for at least 2 out of the past 5 years, that investment property is now treated as primary residence. And the exemption for $250,000 for singles and $500,000 for married couples will apply to the investment property. Is there a way to avoid taxes when selling an investment property? The straightforward answer is yes. A 1031 exchange is a tax code that allows you to defer taxes only if you decide to put all of the money that you just made in the home back into more investment property. If you're considering selling a property but might be considering the taxes you may be on the hook for, my contact information is below.
Stop it. Get some help.
If you received any value out of this video, I'm going to ask that you please like, share, comment, and we'll see you on the next one.